What is the best time frame to day trade with? That is a very important question to answer for yourself. I would recommend every person be aware on higher time frames. I think everyone probably who's trading can agree with that. You need to maybe look at a 1-day chart to get maybe some market bias. Then you could get down to the, say, 4-hour to get a little more granular. Ideally, be getting the 4-hour and the 1-day in agreement of what's going on. You could then go down to a 1-hour. But this video is mostly for what's going to happen or what things to look at that are under an hour. Because I think everyone agrees for 1 day, 4-hour, 1 hour, and plus minus on those, but roughly those time frames are important. So what time frame for the actual day trading and execution? The first thing we're going to look at is 1 minute. The 1 minute chart. I have on equivolume candles. That's why they look like this. They just bake in the volume. It's on NinjaTrader. You just put the equivolume here, but that's why it looks like this. 1 minute. This will speed up your execution. For instance, here, I have this line on every chart we're going to look at. It's a value area high from yesterday, but just a zone. You could put in whatever liquidity zone that you're looking at. Doesn't really matter. It's all just for context of getting in a trade here. With a 1 minute, you get this candle and you could enter at the close of it. If you were on a 5-minute candle, which we'll look at, just to go to the time, 7:35. So your entry is going to be here instead of here. Now, it looks almost as if it's a no-brainer to use a 1 minute candle, but also you're going to get a lot more chop. You're going to get way more chopped up. It all depends on your sizing. So you're with, obviously, the smaller the time frame, you are going to get quicker entries and exits. But depending on what the market's doing, you may get chopped up more. You will get chopped up more, especially if you're basing trades off of indicators, because it's going to, in this zone, once you're up here, whatever indicator you're looking at is probably going to go bullish, bearish. And so definitely have to be aware of that. 1 minute is good. Again, quick entries, but also more chop. So let's move to a 5-minute. Exact same trade. We kind of talked through this. But look where the entry is. I think the 1 minute was right around here. And this 5-minute is here. But also, if you're in some sort of indicator, you'd stay in longer. And, however the trade played out here, this market's random. We're looking at a sample of 1 here. But the higher the time frame will help you stay in trades longer, say on a trend day or something like that. You will, it's just not calculating as frequently, so it's going to be smoothed. It's like using a 50-period moving average instead of using a 10-period moving average. It's going to look a lot smoother. There's going to be less signals. But again, those signals are going to be slower. So depends on if you're scalping or swing trading. It totally depends on your style. 1 minute, 3 minute, 5 minute. 1 minute is very small. There's a lot of people who do trade on the 1 minute. It kind of keeps you more on your toes, which is not necessarily a good thing. It can be. It all depends on the day. But so that's the main difference between 1 and 5. The 5 is just, it's smoother. You're going to be later, but you're going to hold longer most likely. And on a day that goes, up mostly, maybe go a little bit sideways. Where it goes sideways, your 1 minute candle will probably signal you out. And in a 5-minute candle, you start going sideways, you're going to stay long and then continue in the move upwards. So you have to pick and choose what value, what you're really looking for, of how fast you want to trade, how many trades a day you're looking for. And I'd also say, if you're a candlestick, candle pattern, just candle style trader, some people only trade looking at these. A 5-minute time frame would be more useful than a 1 to me, because the 1 has more noise to it. The smaller the time frame, the more useless data there is. Live time, 5-minute candle. This thing's starting to look like it's possibly bullish to scalp back up. But a 1 minute, let's go back to the 1 minute. It's here. It doesn't necessarily look as bullish. This candle looked bullish, so again, you'd get in quicker, and it goes up, and now it's just reversing. So live time, we're seeing, there's more noise in here. And the 5-minute, you'd be waiting on a close here, and then place all your, take profits and stops around this. So that's kind of on the smaller time frame with 1 minute and 5-minute, which are very common things to look for. Some other time frames, I like to use these on smaller, for my smaller time frame. This is a tick chart. So this is more, think of orders that are being filled in futures. It almost blends the two. Because I say that because when there's like right here 7:30 Central, news came out, and so it became 7:30's one candle, 7:31. That candle took 30 seconds to print because a lot of orders were hitting. But later in the day, it's not a good example because it's the market open. Still a lot of orders here. These take longer. That took a minute. That's a minute. So we're still sitting in like 1 minute period. It's 9:41 Central. By the time we get around, say, 11:30, 12 lunch hour, these are going to be taking probably 2 minutes, 3 minutes. It depends. So the cool thing about tick is, since it's related on how much activity there is in the market, when there's a lot of activity, it will be more like a 1 minute candle. And then when it slows down in the middle of the day, it'll edge more towards probably a 3-minute candle. It all depends on how many ticks you're using to calculate. So this is more of a variable and fluctuating candle style. So that's definitely something to look into. I like this. And then there's also this, a range candle. Range candle styles. I use this for day trading a lot because it's price-based. Now, again, there's upsides and downsides to this since it's price-based. When the news came out, 7:30:02, 7:30:02:02. I mean, this happened in 1 second, and it was a pretty good little drop there. So that would probably get you out of a trade, where that 1 minute candle would make you even more patient than this, because this is, you're getting multiple candles in 1 second here. You'd get in quick. So these candles get you in quick. And during chop, you're not going to get near as many prints. Again, the smaller the range, the choppier it'll be if you put the range something higher. Let's see, if we put this to 50, that doesn't add a ton. But all to say, there will be less candles printed, and it's not time-based. So there's, again, plus sides to this. There's downsides to this. You're not going to get, just by glancing at it, like those wicks on the 5-minute and the 1 minute, if you're a price-based trader, here the 50 range just came in. Obviously, there's less candles here. 1 minute, 5 minute, you'll be able to see, these things still have wicks the way that they are, and I actually like using these wicks for some trades, but you're not going to see those beautiful, like on the 1 minute 5 minute there, the 1 minute, like this beautiful thing. That's like a huge wick, bullish close. You can get long there and it would have worked, right? But back on the range, it's not quite as enticing, right? Because you're not seeing the wick, you're just seeing a ton of movement. So it can be a little cluttered, but also it's not time-based. So in times of chop, it just won't act the same way that a 1 minute or 5 minute would. So those are kind of the 4 different candle types, time frames, styles to consider when you're going to look at day trading time frames. Again, you want to start on high time frames, 1 day, maybe even 1 week. 1 week's getting pretty big. It's hard to base any day trades off of that, but you could look at zones and stuff, tops of candles, previous week high and stuff. But ultimately, the smaller the time frame, the smaller the range, the smaller the tick size, the more chop you're going to get, but also the quicker entries you're going to get. So it's just, and commissions add up. If you're opening and closing tons of trades per day, that will add up more than you think. And also you can get chopped up, which is never fun when you're trading. So the smaller time frame, be prepared you're signing up to get more chopped. And if you're the higher time frames, 5 minutes, even if you go 10 minutes, 15 minutes, be aware that you will enter slower. Your entries will not be as pinpointed, but you also hold positions for longer because the chop just simply doesn't mean as much and it doesn't show as much the longer the time frame. So those are all things to consider when you're looking at what time frame to use to day trade.